bank.
Hey Brett, how's it going today?
Good. Hey Ange, how are you?
Good. So are you ready for a trivia question?
No, I thought I said we weren't doing that anymore.
No, so this is a fun one.
Sure it is.
You actually might know the answer to this one.
Uh-huh.
We've talked about this recently. So, what debt to income ratio will they approve? What percentage debt to income ratio will they approve you for on a home mortgage loan?
1.
1%.
No, you wanted a ratio. 1 to 1.
I said what percentage debt to income?
I'd say 50% debt.
50% is what they changed it to in July of 2017.
Woo, got one.
So it used to be 43% of your take-home pay, or of your gross pay each month. Your mortgage, all of your debt, so your mortgage, your car, your loans, add them up, divide by your gross amount, and that could only be 43%. They changed it to 50%. And what's really crazy to me is they use your gross number.
Not your
net.
Yep.
So
okay.
Spoiler, this episode is going to be talking about, can I afford this house? And when I try to answer that question for people, I look at net pay and I say don't spend more than 25 to 33% of your net pay on your mortgage or rent or home bill.
Because your gross is before taxes, it's before anything
401k,
comes out for 401k.
Health insurance.
Yep. Well, anything that the state pulls out. Right, so anything that lands in your bank account is your net, and you're not seeing any of that money otherwise. So, I wouldn't consider that as usable money unless it ends up in my bank account for my paycheck.
Right. And so, I think about it, and with deductions, so the state will take out some percentage, and that varies widely by state. But with Social Security alone, you're looking at 6%, and then Medicare is another 6%, and then federal and state. Realistically, I think a safe estimate is between 25 and 30% of your money is going to taxes.
Yep.
Plus then add in 401k, and then they're saying 50% can go to your mortgage.
50% of that gross number. So
gross number can go to debt, and then we're at 30% for taxes. So then 20% on everything else, including your 401k, which I'm going to tell you to be at 20%.
Right. Car, mortgage, all that super expensive stuff. Yep.
Right. So anyways, I think that's nuts, and I think that's wrong. So that's why we're here, because I've talked to a lot of, and I like mortgage brokers, don't get me wrong. I think they're nice people, but I think their whole job is to get you as much money as they can, because then you walk out happy. So if you go into a mortgage broker and they're like, congratulations, you're approved for a $400,000 house, you're way happier than if they're like, well, realistically, we think that $125,000 sounds about right.
Right, yeah, you're walking out of there feeling a little bit differently in that latter conversation.
So, I think it's kind of a hard field, because, they want to get you approved for the highest amount. Real estate agents want to, it's easier to show houses that are expensive and beautiful, right?
Mm-hmm.
But honestly, I think the hard reality is by loosening up the standards like this, we're going to find ourselves in another housing crisis.
Right, yeah. So that's the direction that it's moving in, right? It's undoing all of those fixes that we put into the system because of the 2008 financial crisis, right? And so, boom, what happens if we allow people to get into the exact same situation? Because they're going to do it, right? People didn't learn anything. The people buying houses now, maybe they are some of the same people buying houses then. Maybe the people that got burned, maybe they learned a lesson in 2008. There's a lot of people that didn't get burned. There's a lot of people that graduated since then that are looking for their first house and would love to have, a $500,000 mansion. And for us, that's a mansion here in Michigan.
Or a $500,000 shack.
$500,000 shack in California, whatever.
Or, you can't even afford anything in New York City at that price.
Right. And so, that's what it is. But they're potentially grossly inflating your lifestyle and letting you do it and get away with it because they're making a lot of money on it. Otherwise, they wouldn't let you do it.
Right. And so, I think we've already talked about why renting isn't the end of the world. But I want to talk about where homeownership makes sense today. So, if you live in a low cost of living area like us and you can buy a super nice house for less than $100 a square foot, then it makes a lot of sense to think about buying a house, right? Mm-hmm. So what are the requirements I say for people? Well, I say that you should have 20% down, which I've talked to so many people and they're like, that's not realistic. How could I ever possibly save? Let's say in this example that we're gonna buy a $200,000 house. Now I know for some of you that is not feasible where you live, and for others of you that's probably a really nice house where you live. But you can kind of adjust the numbers as you see fit. Well, if you want to buy a $200,000 house, then I'm going to recommend that you have a $40,000 down payment. And it's not like $40,000 is the magic number. You're also going to need to bring closing costs to the table. So factor in another 2 to 3%. You're probably going to need about $45,000-ish by the time it's all said and done to close on that house.
Right, because that's not just like little money. That's like, oh yeah, if you were just scraping together the first money for the 20%, now you got to come up with like another $5,000 on top of that, right? Like,
right.
A lot of people don't think about that, and then they're just like screwed at the last minute because you already scraped the bottom of the barrel, pulling money and borrowing from family or whatever, right, to get that down payment in the first place. Yeah,
and so I know like that sounds really intimidating. I remember like when I graduated and I started thinking about buying a house, and I was like, this is never going to happen. I'm never going to get that much money. But a big thing is make it your priority then. And, save every penny to it. If you still have debt, it can be a little bit harder. And this is where if you have debt, then I say if your debt is probably like 4.5% or 5% or higher, you should probably prioritize paying that down before saving a down payment.
You mean if your interest rates on that debt is over that?
Yeah, sorry.
Okay. Not to debt to income ratio.
No, if your interest rate is. But if you are debt free and you're saving this money, like make it a priority and optimize every other area. Like how bad do you want a house versus how bad do you want cable? How bad do you want a house versus how bad do you want to go out to eat? Because these are all, we've talked about this a million times, but if you really want something, like you can make it happen. And I know $45,000 is an enormous amount of money, but if you really make it a priority, it'll happen faster than you think.
Right. Because within a year or two, most people working at median range jobs, right, can probably scrape that together.
I would say 2 to 3, probably more realistically.
Mm-hmm. Without having to sacrifice, every meal to go down to rice.
Well, yeah, and I think, the median income is, what is it, like $58,000 a year, so unless they're living for nothing, they can't save that much in a year.
Right. You'd have to bank 60% of that income. That'd be really difficult.
Yeah. So, I think if you... The big thing is start early. If you are graduating from college and you're going to want a house in a few years, go ahead and just start saving any amount of money, and it'll make a difference. Another big thing is make sure that $45,000 isn't going to wipe you out completely, because once you buy a house, you do need an emergency fund. Every time you buy a house, it's like you're going to want to paint or something's going to break, and you are now 100% responsible for fixing it.
Right. If your furnace goes out, you're going to need a couple $1,000s, $4,000 to get that fixed and a new one put in. And if you live in one of the northern states, that is not an option. Not optional. You have to do that. So, if you live in the South, air conditioning is not optional, right?
Right. All right. So yeah. But going back to it, so I recommend having 20% down for a house, and then, another big thing to look at is what is your credit score, because this will actually directly affect the interest rate you get. Mm-hmm. So, if you have been a slacker and not paying your bills on time, like turn that around right now. Start paying them on time, because when you go to get a mortgage, they will turn over every stone of your financial past and ask you questions about literally everything.
Oh, yeah. And if anybody is like, in scraping together your down payment, and we experienced this when, before we got married and before we merged all our bank accounts and stuff, for the down payment for our first house, I provided some of the down payment into her bank account. Well, then, they looked into that. They pull all your bank records. You have to give them everything. So they saw that transaction where I gave her money for the down payment in the house, and they're like, well, who's this guy? And we're going to need to look at all of his stuff as well now, right? So yeah. I fully opened myself up by just doing that transfer within like a month before we did it.
And you had to sign a thing saying that it was a gift.
Right.
And you were not going to like try to recollect the money from me if anything were to happen, which was really funny. So basically, like, I could have left you and kept the house and just stolen your down payment money.
Right, and I signed a contract that said to exactly that point.
So don't do what Brett did. Protect yourself. It worked out for him, but could have been bad. Mm-hmm. Well, and the funny thing about that, too, is we also got engaged that day. Do you remember?
Not the day that we bought our first house.
We did.
No.
We did legally, because when they asked like, who is this guy giving you this money? I was like, oh, that's my boyfriend. And my mortgage officer was like, could I write fiance? Because that sounds much better. And I was like, sure. And so when you signed that contract that said you were giving me the money, it said, I, Brett, fiance of Angela, am giving her this money. So really, we had quite the long engagement.
That's right. Yeah, that makes it feel better.
But yeah, so, that's another big thing. If you, not even like shady stuff, I'm not even going to go there because they're going to find it, but even if you like have had large transfers from friends or family or anything like that, make sure you have an answer for anything they might ask you about. So I think it's like anything over $1,000 earnings they'll ask you. So if it's your normal job, that's really easy because it's your W-2. But we also have real estate. So we had to transfer into our account from our real estate business. And I remember we had to sign something saying, like, it is from our rental property. And then we had to provide all of our rental history to the mortgage firm.
Right. Yeah, that was, which was not a big deal for us because we have that information available and we're really good at turning it around. But just be aware that, like, every area of your life or your bank account or anything that you have to give them access to and anything that touches those things is part of this process. So it is pretty rigorous, and the faster you can provide this stuff as far as turnaround time goes, the smoother the process will be, right? And a lot of people are really bad at this, and then it delays your closing on your house, and that might delay the interest rate that you have locked in, if that goes up over the, what does it lock in for, 30 days or something?
It depends, again, on your credit score and your mortgage broker. I think they can do up to like a 45 or 60-day rate lock, but a lot of times it's 30 days.
Okay, yeah, so if you take more than 30 days after they lock it in to get the house, then maybe your interest rate is flexible at that point.
And honestly, some might be only doing like a 7-day rate lock right now because the rates have been changing like alarmingly fast. They've been going up quite a bit. So, it just depends, so... But I would say, the big thing is get the paperwork back to them as fast as possible. Don't be the holdup in the process.
Yep.
So I wanted to talk about some math a little bit. Is that cool?
All right. Let's have everybody get their pen and paper out.
All right. Well, so I think this is a good thing. So I'm going to say, let's say that you have an $80,000 salary. I think this is kind of fair because I think some people listening to us probably make that, and some people listening to us probably make half of that, but then their significant other makes up half of that. So I think that's a good like joint salary to go in on. So then your tax rate is 25%. And I'm going to say that you have been listening to our podcast and your 401k contribution is 15%, which is a very healthy rate. So that means your take-home pay is $48,000 a year or $4,000 a month. So let's say that you want to go ahead and buy a house. well, given my 30% rule, where I don't think you should take, more than 30% of your take-home pay to pay for your mortgage, so that means you have $1,200 a month to spend on your mortgage. But when I say mortgage, I don't just mean principal and interest. I'm including taxes and insurance as well. So I used an average rate here. For the tax rate, I used 1.15%. That's the national average. But depending on your area, that might actually be a little low or a little high.
Right. You just have to look up the tax history on that parcel of land, right?
Yeah. So I mean, that's all public records too. So you can literally type in public record property taxes and then type in the exact address and get the tax rate. But something really good to know is if that house was last sold 30 years ago, when you buy it, they're going to reassess the value of it and your taxes will go up.
Yep.
100% of the time that's happened to us. Literally, on one house, it went up $500 a year. So it's not like it's an insignificant amount of money. The adjusted tax bracket
especially when it's been that
high.
long, right? I mean, yeah, because if the house is increased in value, or just if they want more taxes on the house and they haven't been getting them over the years, then they're going to come after you when you buy that house.
Well, and I know this is huge right now in California just because property taxes and values have gone up so much in general, where if a house hasn't been sold since the 70s or 80s, they might still only be paying $2,000 a year in property taxes, and they'll sell the house and it'll go up to $12,000 a year.
Wow.
So definitely just kind of be aware of that. So maybe when you do this search, don't just look for the exact house you're buying, but maybe try to get the whole street and just look at what everybody's paying.
Yeah. But we've talked about that before, where the tricks of owning a house are, those hidden payments of mortgage and taxes, or mortgage is just part of it. The taxes are a huge part of it, right? That you need to consider that people forget about. The interest rate, is a big variable factor.
And
as
the
well.
insurance is more expensive than renter's insurance. Okay, so back to my example. So we have a $1,200 mortgage, and then we have, we'll say $100 homeowner's insurance a month, and then our property taxes, so that'll be $300 for both of those. Which means that we're allowed to have $895 to go towards principal and interest. So really, you can afford about a $180,000 house if you have a 30-year mortgage.
Okay, so we were shooting for a $200,000 house. Our income basically tells us that we can only get a $180,000 house.
But you're real lucky because you saved up that $40,000 down payment, so you can add that. I just did the mortgage balance amount, so add that back in so you can have a $220,000.
Oh, great. Okay. So we hit the number. And that then is that including closing costs?
So that's where you need the $5,000 extra in closing costs. So if you save up $45,000, then the $5,000 goes towards closing costs, and you're under goal, right? Because you wanted a $200,000 house. The mortgage you can get approved up to $180,000 in my expert opinion, but really then you'll get a mortgage for about $160,000. So your monthly amount will be less than that $1,200, and you'll check out in all my math.
Great.
Which is good. So, I think that's just a quick example to show you that it's kind of important to work backwards. So, what I really recommend for people is find out what your take-home pay is every month, take 30% of it, then subtract off, $100 for an homeowner's insurance, and then try to get a feel for what your property taxes might be, subtract off that amount, take what's left, and you can literally put it in almost any time value of money calculator and figure out what will this translate to as a lump sum. And then that gives you a better range for what your budget actually should be. Another thing I wanted to point out is, a lot of times I recommend that you make the math work on a 15-year mortgage, which that will greatly increase your monthly payment or decrease the amount of house you can buy.
Right. Well, I mean, it'll almost double it, right?
So actually not quite, because it's you're paying so much interest in the beginning, especially on a 30-year mortgage, that, sometimes you'd be surprised. Like if you're looking in the $200,000 house range, it might only impact that number by, $200 to $300 a month.
Okay. Wow, that's a big difference.
Which I know, that kind of sounds like a lot of money, especially when we're talking about, keeping it in a certain range of your income. But at the same time, like an extra $200 a month, let's say, to be done with your mortgage 15 years earlier, that's kind of worth it. You pay a lot less interest on these.
Right, because you should be paying you should be paying an extra $1,200 a month.
Right.
So if it's only $200 a month, then big bargain sale, right?
Right. And another big thing that I advise people to remember is, think about what your age is. So, I bought my first house when I was 23. So I could easily get a 30-year mortgage and pay it off when I was 53, right? If I lived there the whole time. Great, But if you are buying a house in your 40s, do you really want to be making mortgage payments into your 70s? Or do you want your mortgage payments to end kind of when your working career ends so that you can go into retirement without having that debt hanging over your head?
Right, because you're probably not going to be able to afford the same mortgage you are now working when you're in your retirement age, right? That would be very unlikely.
Right. And, just a lot. It's another variable to plan for of fixed expenses. I think a lot of people, when they retire, try to minimize their fixed expenses as much as possible so that they can adjust if they need to. So, that's another thing to think about. And I think 15-year mortgages, a lot of people get scared by them because it is such a larger upfront commitment. But, that's why I advise people, like, go into it knowing your number and, that way you can adjust down if needed. So, in the same example I just gave, I said we could afford a $180,000 house with our 30-year mortgage. You could probably afford, quite a bit less with the 30 or 15 years. So maybe like $130,000 to $140,000 range. So, that's $40,000 to $50,000 less.
That's a lot. Yeah.
Or like I said, maybe the trade-off is a higher payment. But just look into it and think about it and think about what fits your needs best. Because, with a 15-year mortgage, you actually do usually get a lower interest rate as well, which might allow you to afford a little bit more house too. So you have to play with the numbers. And these are all things that if you go to a mortgage broker, you can talk through them with. So I know my mortgage broker was actually very happy to send me over like an amortization schedule so I could like plug in different values into a 30-year or 15-year and get a feel for what I could afford and what the payment would be.
Yeah, and so that's a good point too. We've talked before about, picking the right financial planner, picking the right real estate agent, picking the right people to be basically, quote unquote, on your team of professionals that are going to help you be successful in doing all these different things. Mortgage broker is a very important one also, because there's a lot of bad ones. There's like, you can go straight to like Quicken Loans and they're going to sell you anything, but your interest rate's going to suck, right?
Or they're going to not care about you and they're going to push for you to get into the highest, most expensive houses possible.
Right, because that's going to net them the most money over time. And they don't care what happens, whether you bankruptcy on it or not, because as soon as you close on that house, they're going to sell your loan to somebody else. Right? So they don't have to deal with the downfall. So they're gonna bump it up, get into $1 million house. We don't care, right? We're gonna sell it to Fannie Mae.
Oh, I mean, you better believe it. They're gonna look at your gross income, and they're gonna take 50% of it, and they're gonna be like, "That's what your monthly mortgage could be." Then they're gonna plug that into their 30-year calculator.
Yep.
With a probably like slightly lower interest rate than you really might qualify for, and be like, "Oh, this is what you're pre-approved for."
Mm-hmm.
It's a disaster waiting to happen.
Yep. And so, yeah, the looser the rule, like as we talked at the beginning, right? The looser the rules get, the more these companies are going to keep following that model and keep pushing the envelope on that and getting people into things that they're not supposed to be able to get into. And then if anything happens, you're just you're out of luck. You can't make the mortgage payments. They take your house back, and it's 2008 all over again.
So, I will say, when picking a mortgage broker, typically credit unions will have the best rates. They will get you the lowest rate on a house typically. So that's one route to go. And the nice thing about credit unions is they're local. The people that work there are pretty nice. So if you go in and ask them questions, they're very willing to work with you. So it's a good environment for a lot of people. Another thing I recommend is there are just straight up mortgage places that you can go. And that's what I went through both times buying a house. And I just found one that I remember the first time I sat in that office, I wasn't even ready to buy a house yet. Probably not for another year. But they were just very patient, willing to help explain everything to me, explain the process, gave me different worksheets so that I could work through what I could afford.
I think, and correct me if this is wrong, but I thought the guy that you worked with originally, or the last one we worked with on this house, he wouldn't even tell you what the number was that you were pre-approved for.
That's correct.
Right? So he was not like, oh yeah, you can get into a $500,000, $1 million house because you have a great job and you have no debt or whatever.
Yeah.
He was just like, you come to me with the number for the house that you want to have, and I'll tell you if that is
And he helped give me resources to figure out what that number should be. I remember he gave me this worksheet that I worked through, and I came up with a number, and I brought it to him, and he was like, I will tell you yes or no. And then it was really funny because through other channels, like Quicken Loan, I found out what I was actually pre-approved for from the big guys. And it was literally double what I came up with. And that's why I wanted to really make this podcast to be a cautionary tale of don't just listen to what Quicken Loan tells you, or any of these guys. I don't just want to pick on them, but make sure you crunch the numbers yourself too. And if you're not good at crunching numbers, please send me an email and I will crunch the numbers for you. I'm not doing this to be a jerk. I'm doing this to help people because I really understand the math behind it. And I understand that people are getting screwed over right now. Literally, I came up with a number that was half of what they would have approved me for. And we were both paying for it. But that was just my approval alone. You weren't on the mortgage.
Right.
Brad.
Angela and I were both contributing toward the down payment of the house. And we're both contributing to the mortgage. But she is the only one that signed for the mortgage rate.
It was only based on my
income alone. They gave her some ridiculous number that I wouldn't be comfortable with if we had 4 people paying for the house, right?
Right.
It was so high.
And I understand we're really conservative, but I just think it's really important to beat this home because I think a lot of people are jumping into getting these mortgages because they're oh, well, the expert told me I can afford it. Well, let me tell you, just as we talked about with financial planners or other insurance brokers or real estate agents, there's really good people in the field and there's really bad people in the field. And some people are just out to make as much money as possible, and they don't care if you end up bankrupt in 3 years.
Right, because again, they're going to just sell your mortgage to somebody else and they don't have to deal with it.
So yeah, my big advice is go to a credit union, go to an independent mortgage broker, but crunch the numbers yourself too. And, make sure you're staying in that 25 to 30%, range of that's where your mortgage payment should be. And then everybody's happy. And if you can do a 15-year, do it. That's the one thing I agree with Dave Ramsey on.
So what about the people that can't quite qualify for the 20% down this year? It's okay for them to continue renting. It's okay, even if your rent's $1,000 a month or wherever you live, right?
And that, again, it's really highly dependent on location. Run the rent versus buy calculators. If it's $1,000 to rent in their location, but their mortgage and, property taxes and everything would be $700, then maybe get into a house. We actually bought our first house with 5% down. And because it was a really good time to buy in our area, and our mortgage was so much less than our rent, $300 less than our rent with a PMI.
At the time, and I think they were raising our rent, which even made it even worse.
Yeah.
It was closer to $500 a month, I think, almost.
So we had a PMI, and we aggressively paid down our mortgage so that we got that taken off within the first year of homeownership.
Right, and the PMI is a penalty that you pay for not having 20% down.
Mm-hmm.
And depending on who you get your mortgage from, that PMI may not go away until the full value of the house is paid off. Ours, in the situation that we had, it was, we understood this well before we were signing up for it, that if we hit the 20% number, the PMI would drop off. But that didn't happen automatically. We had to chase that down. It was a huge pain.
Yeah.
Right. They did not want that to go away.
And they will tell you it just drops off. No, it will be a mess. PMIs are not fun. I don't wish them on anybody, but I understand sometimes it has to happen. There are some credit unions now that will do 10% down with no PMIs. So again, explore your options. I'm not completely opposed to not having 20% down because I know we did it. But just make sure if you're doing it for a reason, not just because you think owning a home is the best decision you can make. Because houses are money pits. So by the time you buy a house, make sure you are really confident in your decision and you have, a good source of an emergency fund for when shit happens.
Because it will, right? I mean, we've owned homes for only just over 6 years now, almost. Mm-hmm. And we've replaced furnaces. We replaced, siding.
Yeah.
We had a flood in the kitchen at one point. And had to deal with that and the insurance claims and all kinds of stuff. We've had air conditioners die. We've had air conditioners serviced. And
you have to mow.
And I have to mow. We've replaced flooring in one of the houses. Oh, so much mowing. So much snow plowing, shoveling driveways. Maybe there's a slip and fall or something that happens if you're not on top of that game. Cleaning up yard work, sticks falling in the yard. A tree fell over in one of the yards.
All right, I'm gonna stop you. Owning a
joys of home ownership, ladies and gentlemen.
So what is the advantage to owning a home for you?
I think we should go back to renting. More convinced of that every day.
Yeah. All right, boys and girls. So our podcast to try to convince you to buy a house is just.
Right. I do want to conclude with there's a lot of very successful people that don't ever buy a house. Right. There are lifelong renters that make that work. It frees up a lot of your equity.
So to play devil's advocate, owning a home is a really great guard against inflation. It is an inflation protected asset because you lock in that price. You pay your mortgage that doesn't change for 15 or 30 years, and you have an inflation-protected asset. It is not an investment. We have investment properties. Our home is not an investment. We buy it to live in it. It's diversification. We're really risky with 90% of our portfolio, and our home helps us balance that out because it's a very safe investment, right?
Right, but it's also, over $100,000 of equity at some point that's just sitting there not making us any,
And because we are very aggressive investors and we have 90% of our money invested very aggressively, it is really hard for us to see the equity in our home not going to better use sometimes. For sure. But I'm saying for the average person, homeownership's, and another big thing that I was talking to Brett about this morning is homeownership for a lot of people is a forced savings account. So if you're not good at saving money, you have to with a house because you make your payment and you build equity and you don't think about it. So a lot of people, if they had $100,000 of equity in their home, they don't think about it. They're going to leave it there, right? But if they had $100,000 sitting in the bank, they'd be like, Tesla, what? So houses are really good for that. It forces people to save money and build wealth, which is good.
Yep. So then going into your retirement, you can sell your house and boom, you have, over $100,000 or $500,000 or wherever you live, whatever that asset is, that is part of your retirement strategy at that point.
Exactly. So homeownership is not all bad, but just make sure you're going into it prepared, which means you have, a reservoir of money, which might take you years to build up, but start now, right? That's what we always say.
Start early, let the compound interest, do its thing.
All right. Well, I think we're pretty good there. So if you have any other questions or, very seriously, if you are not sure how to crunch these numbers, I will drop my contact information in. I love this stuff, so I will help you, no strings attached. I will just help you. I will send you spreadsheets that I've built. and I will help you get on the right track.
Or even maybe tips about, how to find the right house in your price. Or, once you do find your number, how do you find a house that isn't a lemon too? I mean, we have a lot of experience in that area as well. So, the home buying process, we've kind of been helping a lot of people out with lately. So, give us a call or send us a note.
Yeah, for sure. Or, come on over and we'll make dinner and talk about it. So, gosh, we are so Midwest right now. Yep. We're like, come on over. We'll cook and help you with things. Like, sorry, we're Midwest. Can't help it.
All right. Anything else?
I think that's it.
All right. Great. Thanks, guys.
Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.